Hello, financial enthusiasts! Welcome back to Stock Market Callus, where we reveal the secrets to financial success in building a solid foundation for a brighter future. If you've been following our series on options trading, you've already taken your first steps into this fascinating world. In part 1, we introduce the concept of options, discussing how buying calls can lead to potential gains when a stock rises, and purchasing puts can protect you during market downturns. But we know that for some of you, the idea of options trading might still seem a bit abstract. Fear not, because in today's video, we're diving deeper into the intricacies of options, providing you with further explanations to make this concept crystal clear. So, whether you're a complete beginner or someone seeking to reinforce your understanding, this video is tailored just for you. Grab a cup of your favorite beverage, sit back, and get ready to expand your options knowledge. But before we get into the nitty-gritty, let's clear up one thing. Option contracts aren't physical pieces of paper. In fact, everything happens electronically in the modern world of trading. You can buy or sell an option contract with your brokerage account within a matter of milliseconds, just like trading stocks. Now, let's talk about what you're seeing on the screen. This is what we call an option chain. An option chain is essentially a comprehensive list of all the available options for a particular stock. It displays the prices of each option and gives you a glimpse of the entire options market. You can easily find an option chain on your trading platform or various financial websites like Yahoo Finance, Google Finance, and more. For this demonstration, we're using the option chain from our trusted brokerage firm. Every popular company and many stocks you might already be trading have options available. To check if a stock has options, all you need to do is type in the stock's ticker symbol. If options are available, you'll see a wealth of data listed below. If not, it'll simply indicate that no options are currently available for that symbol. Let's take a deeper look at Apple stock options by entering the ticker symbol AAPL. As you can see, there are numerous options contracts accessible for trading. The abundance of options may appear intimidating at first, but don't worry, we'll break everything down as simply as possible. Before delving into why option prices are what they are, let's go over some key options characteristics. In addition, we will walk you through the process of reading and comprehending the option chain. First, we need to choose our expiration date. The expiration date, as you might recall, is simply the date when the option contract will come to an end. As you look at the option chain, you'll notice a list of available expirations with the actual dates they expire displayed. The number in the center indicates the number of days left until each expiration date. For instance, clicking on an expiration date like July 17, 2020 will reveal all the options that expire on that day. As of now, that date is only 11 days away. Keep in mind that we're still covering the very basics, so we won't discuss which expiration date you should be trading just yet. Choosing different expiration dates for options comes with its own set of advantages and disadvantages, which we will explore in detail later in this video. For now, let's focus on grasping the fundamentals. We'll begin by selecting the expiration date that is 11 days away. Once you click on this specific expiration date, a comprehensive list of options for that date will be displayed. On the left side of the screen, you'll find the call options that expire on this chosen date, and on the right side, you'll see the put options that also expire on the same date. This segmentation helps us better understand the available options for our trading decisions. Let's suppose we're interested in trading a call option with an 11-day expiration. Now, the next step is to select our desired strike price. The strike prices for each option are listed vertically through the center of your screen. It's worth noting that the arrangement might seem counterintuitive since the strike prices are in ascending order. One might expect higher strikes to be higher on the screen, but that's just how the option chain layout works, and you'll get used to it. Just like selecting an expiration date, choosing a strike price is essential. However, we won't delve into the specifics of which strike to trade until later. For now, let's pick the 385 strike call option. So now, we know how to navigate the option chain to find a specific option. You can pinpoint a call option or put option with a particular expiration date and strike price. Similar to stocks, options have bid and ask prices. You're probably already familiar with these concepts. When buying an asset, you'll acquire it at the ask price as that's where the sellers are. Conversely, when selling an asset, you'll sell it at the bid price because that's where the market is willing to buy it from you. Now, let's shift our attention to the pricing of this option and understand how it works if you decide to trade it. Unlike stocks that trade in shares, options trade in contracts. Each option contract has the power to control 100 shares of the underlying stock. Let me clarify this concept for you. Remember, a call option grants us the right to buy the stock at its strike price at a later date. So, if you want the right to buy 100 shares of stocks in the future, you'll need to purchase one option contract. On the other hand, if you desire the right to buy 200 shares of stock in the future, you'll have to purchase two contracts. That's what we mean when we say one contract controls 100 shares of the stock. Let's assume we want to buy a single contract of the 385 strike call option. Now, the question is, how much will it actually cost us? If we look at the option chain, we can see that the bid price is 276 and the asking price is 281. To purchase this option, we'll have to pay the asking price of 281. But here's the important thing to understand. It's going to cost us $281 per contract. This is because each option contract represents 100 shares, and option prices have a multiplier of 100. I know this may seem a bit confusing at first, but don't worry. With practice, it will become second nature very quickly. One trick you can use is to think of these prices without the decimal point. So, if the price is 2.81, just remove the decimal, and it will cost you $281. Let's recall that trading options don't necessarily involve buying or selling the actual stock. Similar to how stock prices fluctuate daily, option prices also vary and move around regularly. In the upcoming part 3 of this video, we'll delve into what causes these fluctuations and the factors influencing the rise and fall of option prices. For this example, let's assume we purchase one contract of this call option at $281, paying $281 in total. Over the next week, the option's price rises from $281 to $4. Now, as with any asset, we have to make decisions about when to sell. Let's say we decide to capitalize on the profits, so we sell the call option we own at $4. So, if we bought something for $281 and sold it for $400, it's evident that we made a profit of $119. Now, let's take a look at another example to practice. Instead of buying one contract of this call option at $281, let's say we want to purchase two contracts. The concept remains the same, we're just acquiring twice as many contracts. So, if one contract costs us $281, to determine the cost of two contracts, we'll simply multiply that by 2. Therefore, two contracts would amount to $562. Now, if the price of the option increases and we can sell both of our contracts at $4, it means we turn our initial $562 into $800. Our profit in this case would be $238. There are 3 factors that influence an option's price movement, ultimately resulting in either a profit or loss. We briefly touched upon the first factor in the initial part of our options trading series, which is the movement of the underlying stock price. When the stock price rises, the value of a call option typically increases, whereas a put option's value rises when the stock price declines. In simple terms, if you buy a call option, you're anticipating the underlying stock's price to rise, and if you purchase a put option, you're speculating that the stock's price will fall. However, it's crucial to note that there are 2 other significant factors affecting an option's price. These factors are of utmost importance, so before rushing to buy options, we'll thoroughly explore them in the third part of the series in options trading. And that brings us to the conclusion of our second episode of the options trading series. In the upcoming video, Investing for Beginners Options Trading Part 3, we're diving deep into the 3 factors that influence an options price fluctuation. Now, don't miss our latest video, Investing for Beginners Options Trading Part 1 of our options trading series. Here, you'll gain a practical understanding of buying and selling call options and put options.